So, Simon, you did quite a lot of research on Abraj. You were first approached by a whistleblower in 2018. Is that correct?
Yep, that's right. January 2018.
And that's basically sent you down the foxhole onto a hunt. Now, let me just say, for me, one of the most shocking parts of the Abraj story was maybe not so much, was aside from that it happened, how long Abraj was able to kind of maintain that screen of legitimacy, how long they were able to make their movement of funds from one to the other a secret from what looked at face value a group of quite experienced investors. Was this a surprise for you as well?
Yeah, it was a very big surprise. The end of 2017, Abraj was the largest emerging markets private equity firm. It was managing $14 billion, active across Southern Asia, Southeast Asia, Middle East, Africa, Latin America. Its investors included the World Bank, the British, American, French, German, many other governments, the Bill and Melinda Gates Foundation, Bank of America, Hamilton Lane, Goldman Sachs. So this was a firm which had convinced some of the largest and most experienced financial institutions in the world to trust it. And the trust was bestowed in Abraj and its founder, Arif Naqvi, because he was making the pitch that Abraj could make money for investors and end poverty at the same time by investing, buying and building companies, hospitals, schools in developing countries, so across Africa, Asia, and Latin America. So all these investors, they believed Arif, they believed Abraj, and lo and behold, in January 2018, we receive an email which says that there is a serious problem at Abraj, and initially the whistleblower was saying that Abraj had a $1 billion healthcare fund. So this fund was dedicated to buying and building hospitals in Africa and Asia. And the pitch of the fund was very specifically to solve the healthcare problems of poor countries, that they would build low-cost, for-profit hospitals and clinics, make money, and provide a service that wasn't there. So a win-win situation. The fund was heavily marketed around the world at conferences, including the World Economic Forum's annual gathering in Davos in Switzerland. And Bill Gates had put in $100 million, and that convinced the World Bank to put in $100 million, and many Western governments followed. So the whistleblower said that $200 million had gone missing from this fund, and the investors didn't know where it was. So in effect, the investors in that fund were launching an investigation to find out where their money was. While we were being told this by the whistleblower, who wouldn't give their name because they said they were afraid that if they did, they might lose their job. They said they were an Abraj employee, or something worse might happen to them. While we were receiving this information and having a back and forth with the sender of the email, Arif was actually in Davos at the World Economic Forum, and he was speaking on a publicly televised panel with Bill Gates about the future of global healthcare. So we were presented with this public image of Arif and Abraj being on the world stage, talking about how to make money and do good, while receiving privately an email which says this whole thing is a massive scam. And so we got, we were presented with these two very opposing truths, if you like. One is the public image of Arif and Abraj making money and solving problems with billionaires like Bill Gates and governments. And the other is this unsubstantiated private email from someone who won't give their name saying, this is a scam. There is $200 million gone missing, and the investors would like to know where it is. So that was the start point for us, Claudia.
So, I mean, maybe just for context, I mean, what surprised me at that point already, that the alarm bells had not been ringing early on, because private equity funds, as do hedge funds or any investment vehicles, have very clear rules and processes on how to treat their investor money from their own money, how to maintain them, how to keep those investable funds in separate accounts. Usually you get to see account statements as well. So you usually know where that money is. So it's a bit unusual that they kind of had to ask about that and had not been informed. Did you do any work on like what a barrage's kind of back office, if I call it, looked like?
Yeah, we did an awful lot of work. And it's just like investors usually think they know where their money is in private equity firms, because in all of private equity, there is an extraordinary amount of secrecy, which is not to say that that secrecy is being abused, as it allegedly was in the case of Abraj, but there is an extraordinary amount of secrecy in private equity. And firms which may be based in Dubai or Singapore or London or New York very often incorporate their funds in jurisdictions like the Cayman Islands, and you know, it's very hard to get information about these funds. I mean, it's always been very hard for the public or journalists who represent the public, but the extraordinary thing about the Abraj story is it turns out it was very hard for the investors to find out what was going on with their money. I don't know, can we pull up one of my slides? Is that possible?
Sure.
So early 2018, Abraj is raising, can we pull up my slide 5, the whistleblower email? So late 2017, early 2018, Abraj is raising $6 billion for what would have been the world's largest emerging markets private equity fund. And yeah, this is the one. And so this is September 23rd, 2017. So this is before January 2018. So I and Will, my colleague, and we had no idea about this email being sent when we started reporting the allegations at Abraj. But what had happened, as this email shows you, this email went out to all the investors who'd signed up to Abraj's $6 billion fund. It's an anonymous email, another whistleblower email, maybe the same person that contacted us, maybe not. So it comes from Abraj Fund 2017 at yandex.com. So that's a Russian server. And this email says, before investing in Abraj Fund 6, which is the $6 billion fund they were raising, do your due diligence properly and ask the right questions. You will be amazed what you discover. The areas you should focus in are like unrealized gains valuations. These are manipulated beyond anything you have seen in any fund and easy to uncover. Don't believe what the partners send you or what the deal teams send. Ask for the primary source data and audit accounts of the underlying. Blah, blah, blah. Cash is used to fund the working capital of Abraj and easy to audit. Ask for the financials of Abraj and subsidiary. Follow the debt and cash profit versus non-cash. Get to the bottom of the Karachi Electric story, presented as a success of Abraj turnaround, but behind it there is the tariff fraud, which is why the deal is delayed with Pakistan Chief Minister. Don't believe the slides and presentations or any information which comes. Diligence it yourself with primary data and you will find the truth. Don't be the foolish LP who signed commitment while the other LPs who got the email started digging. Don't believe what they tell you and check the fact. Protect yourself.
Did you have a chance?
Now that went.
did you have a chance
Sorry,
to
yeah?
talk to some of the LPs? Did you have a chance to have conversations
Yes.
with the LPs?
This email went out to all the LPs which had committed to the new $6 billion fund. So billions of dollars had been committed to this fund from institutions including Hamilton Lane, which is one of the largest, most experienced private equity investors in the world, which was investing money on behalf of US pensioners. So the Washington State Pension Fund, Hawaii, Texas teachers, Louisiana teachers. These people's money had been committed to Abraj by Hamilton Lane. What did Hamilton Lane and all the other LPs do when they received this email? Practically nothing. So Hamilton Lane did ask Abraj about this email. They did say, hey, we received this. What do you have to say? And Arif, he responded in an outraged fashion. His response to Hamilton Lane was, this is outrageous. How dare they suggest there's anything wrong? How dare you suggest there might be anything wrong by asking us about it? And that was the end of the conversation. So the limited partners, even when they received this email, did nothing. Now, I have spoken to LPs subsequently and said, how is it possible that you did nothing when you got an email like this? And one of them said to me, well, actually, we get quite a lot of emails like this from aggrieved employees or competitors. And my response was, what? And you ignore them? I mean, in my experience as a journalist, 21 years, where there's smoke, there's usually fire. It might not be a lot of fire, but there's probably something going on. I personally would not have ignored this email. And if the executive of the firm I asked, hey, what about this email, gives me an outraged response, like, how dare people say this about us, that would make me more suspicious, not less suspicious. So something bad is going on at Abraj. And as Claudia said, language is important. And I agree with Claudia very much on that. And the extraordinary thing about the whole Abraj saga is the incredible distance there was between what Abraj said and what it did. And this is the key tension in the whole emerging debate about sustainable stakeholder capitalism versus shareholder capitalism and impact investing in ESG. So now we have investors who, and I think this is a positive thing, company CEOs, investors are acknowledging that making money for shareholders is not sufficient as an objective. It is an important objective, very important, but there are also other objectives that investors and CEOs are now being asked to acknowledge, and they are acknowledging, which is to consider the interests of their employees and their customers and the communities where they work. But the reason why I think the Abraj story is so important is because it shows that even when companies and investors sign up to this broader stakeholder capitalism mission, big problems can emerge. And that's certainly what happened at Abraj.
And would you also argue that the investors have actually a responsibility? So just basically saying, okay, we're going to allocate X% of our assets under management to investors that are doing good and delivering some kind of profit is just not good enough, which basically requires a pretty active LP, but also a very knowledgeable LP that regularly basically updates itself. So having said that, I mean, after your book was published, and I would argue read over summer by definitely every LP, do you think the LPs have made any changes to their oversight procedures? I mean, are you aware of an LP that may have sent you a note and said, look, thanks very much. We didn't realize we were flying, pretty much without any protection. So maybe we need to kind of look at our processes and procedures and make some changes?
So yes, there have been specific changes, and I can tell you about those. But more broadly, I'm pretty disappointed with the response of the private equity world to the Abraj saga. But in terms of, here's a specific example of a change that was made. So I was speaking to a private equity fund manager from Eastern Europe last week, and he's trying to get money from investment from the IFC, the International Finance Corp, which is a part of the World Bank. And he said it took a lot longer than expected, and that's because the IFC is now doing a lot more due diligence on the firms that it invests in, and that specifically the IFC had required that this private equity firm to promise not to borrow money at the GP level. So this is a part of the Abraj problem, which is that the holding company of Abraj was borrowing billions of dollars and taking on liabilities which it couldn't afford, and then being forced to move money around in a way it shouldn't have done to avoid going bust for years.
Right.
And
money, not their own
one
money.
way of solving that is, in the IFC's point of view, is to get the private equity firms it invests in to promise not to take on debt. And that is a direct consequence of the Abraj situation.
So that's debt on the company, on the fund level, not debt.
No, above the fund level, at the GP.
On the GP level.
Yeah.
On the GP level. You said you were disappointed. What had you expected from private equity after your book was published?
Well, I guess you're right. I shouldn't have been disappointed, because I know that private equity investors never want to talk to journalists. But the contention of the book and the contention of Abraj was, dear world, give us the money. We will make money and end poverty. That was Abraj's pitch, and it's a great pitch. And what's not to like about a private equity firm that says can make you rich and make poor people less poor? Now, when Abraj, with that pitch, I think, and I just want to say here, there's one thing that's important to say. So in the end, jumping to the end, 6 Abraj executives have been criminally indicted by the Department of Justice. And Arif Naqvi, the founder, faces 291 years in jail if found guilty of all charges. He says he's innocent. 2 others have pleaded guilty. So I just want to make that clear. But in financial fraud, so Wolf of Wall Street, the Wolf of Wall Street's pitch is, give me your money, I'll invest it and make you more money and give it back. Bernie Madoff's pitch was the same to rich people: give me money, I'll invest it, give you back more money than you gave me. Now, Abraj's pitch and the broader impact investing world's pitch goes beyond that. It's give me your money, I'll make you money, and we'll end poverty well. We'll provide a financial return to you and a public good, a public service, something that makes the world a better place. And I think there's a bigger betrayal in making that pledge than if you're just pledging to make someone wealthier. I think that's why this story is so important. And because of the sort of pitch to end poverty, provide SDG solutions, Abraj was able to raise a lot of money from the development finance institutions of governments. So US government's Overseas Private Investment Corp, UK government's CDC, French government's Proparco. These are government institutions that invest in private equity funds, mainly in emerging markets, as a way to stimulate the economies and put money into funds that are supposed to be investing in areas of those economies where jobs and services are needed. And when these private equity firms like Abraj are raising this money, they are going around the world, they are speaking publicly and at private conferences, and they're making a pitch. about what they're doing. And investors are equally sort of explaining what they're doing, whether it's the World Bank or CD or OPIC. Now, the issue is that when it's going right and people are raising money, they're quite happy to talk. But when it went wrong, no one wants to talk about it. And so that's the situation we're in now with Abraj, the IFC, CDC, OPIC, which is now called the US International Development Finance Corporation. They do not want to talk about this. Now you might think, of course they don't. I think they should, because if this is about providing a common good, a public good, and it's with taxpayers' money, you know, your money and my money, then what's not to talk about? And I think the refusal to discuss this issue is also preventing an important learning and a healing process, so that the industry can actually understand what went wrong with Abraj. What did they do right? They did do something right. They did do things they should not have done. Let's talk about it. Let's learn about it. Let's not repeat the same mistakes, and let's move on. So I asked CDC, which is the UK government fund that invests in Abraj, to talk, and they didn't really want to do that. So I submitted a Freedom of Information request. So it's a UK government Freedom of Information Act, allows journalists, citizens to ask information. So I did that. And the response I got back from them was that the public interest in not answering my questions was greater than the public interest in answering my questions. I respectfully disagreed with them. I complained first to them, and that didn't change anything. Then I complained to the UK Information Office, who are sort of like a regulator, and they didn't do anything either. So we wrote a book about it instead, because every page of this book, there's someone that didn't want you to know about this. I mean, this is 3.5 years of investigative reporting. So I guess, I mean, I was hoping that the public institutions might be a little bit more transparent than they have been, Claudia, but they haven't.
So your phone has not been ringing off the hook.
Well, it was ringing a lot. So we have a lot of sources within these organizations and elsewhere, hundreds of people we've spoken to. Yeah, there are good people all over the world. There are good people in all organizations. There are, you know, we had 70 plus sources inside Abraj who, you know, good people that wanted to find out what had been going on at their firm, and helped us to find out and tell the story. But institutionally, you know, formally, these institutions do not want to talk. But yeah, we are talking to a lot of people within institutions, even when those institutions don't want to talk to us.
Yeah. So back to your comment on it would be useful to have those conversations for an educational point of view. So we can take that offline, but I'd be delighted to basically be someone that offer INSEAD as kind of the neutral entity to collect that feedback.
Well, I think, sorry, Graham Wrigley is part of your community, right?
That's right.
Well, he's the chairman of CDC, so you can ask him about it.
We can have a conversation, but it helps at times. So I mean, again, that's where academia sometimes comes in handy, where you can basically provide the insurance that comments will be kept anonymous. Because frankly, I mean, I'd be interested to hear about the learnings that are going on even behind closed doors and share them with other LPs. We have plenty of new LPs joining the private market community on a daily basis. I think this would be an interesting book or an interesting manual. I hope it wouldn't turn into a book, but maybe a manual to add on to how LPs should allocate their money into private markets and ensure that they get it back. So without having to go to the courts.
So, I mean, there's a lot to talk about there. So often investors, firms involved, they're embarrassed. They don't want to talk about it. I get that, but I'm not sure that's just a reasonable excuse. There is litigation ongoing, which makes it hard.
That's true.
for investors to talk about this. I get that, but I don't think that's the whole of the story. I think, there's a lot of secrecy in private equity, and often people hide behind that. I have spoken to some investors who said, our objective is to get our money back. It's not justice. We don't, we want to get our money back, and having a large criminal case going on doesn't help us. I mean, I think, the ideal situation is the investors get their money back, and justice is done. We don't have to choose between the two. And I think that's really important. And then, investors often say, well, Abraaj was an exception. It was extreme. It's not representative of the industry. I mean, yes, it was extreme. I do think there are issues. And then investors also say, look, this is an auditing problem. KPMG was the auditor of Abraaj. I mean, what were they doing? It's a very good question. But again, it doesn't exonerate investors from not understanding for years what was going on at Abraaj. And then beneath the last thing I want to say about even beneath the fraud, the alleged fraud, there were issues, and I think these are in some ways even more important issues. So Abraaj's $1 billion healthcare fund was explicitly set up as something that would solve the lack of healthcare in some of the poorest countries in the world, as through for-profit healthcare provision. And they did buy and build some hospitals in India, Pakistan, Kenya, and Nigeria. But I have, and this is referenced in the book, emails from Abraaj executives to other Abraaj executives saying, we can't serve the poorest with this fund because we won't make any money. And that's really a problem, because in the marketing pitch at Davos and elsewhere, this was the fund to solve all of humanity's healthcare problems. And then if internally you've got Abraaj executives saying, well, maybe we won't focus on the bottom of the pyramid, but the top of the middle, that's misleading. And, again, the CEO of the healthcare fund, he's quote, mentioned in the book, they were building a hospital in Lahore in Pakistan, and the CEO was looking around the hospital site, and it was, sort of in green fields, and there were very poor farmers with bullocks working those fields. And he said to himself, these farmers are not going to be able to afford to go to this hospital because it's too expensive. That's a real problem if you're pitching your healthcare services as healthcare services for the poor.
Sure. I mean, it goes back to your comment at the beginning. You said it was basically presented as a win-win. We can basically we can do good, we can offer those services for the poor and still make money for our investors. And whilst this may be possible, and I mean, there are institutions that are in the UK, in the US, basically working, but in very different kind of models and settings. And so maybe that's a good transition. I'm happy if there are questions coming in, basically jump back to the questions on Abraaj. But I mean, let's transition over. I mean, you have a good understanding on how the model of private equity works. You raise commitments from investors for a fixed period of time. During that period of time, you find investable assets that you deploy capital into. You manage those assets to a successful exit, and then you return the money to the investors, ideally with some profit. So that's, in a nutshell, what private equity does. Can the model then, as it stands, be combined and married with the idea of impact investing? So can you basically, do you think it's possible, and would it have been possible to create this healthcare fund that with $1 billion that would have done what it promised?
I think it's possible. So certainly not, my conclusion is not this whole effort is a waste of time. I think it is possible. It's difficult. And we really need to talk about it. And we need to learn the lessons from what goes wrong and kind of celebrate learning from what goes wrong as much as celebrating what goes right. I think it's great that capitalism is taking on this broader mandate, but it's complicated. It's hard to make money. It's hard to end poverty. It's very hard to do those two things at the same time.
Yeah.
And sometimes, arguably, a company which doesn't set out overtly to solve a social problem can arguably end up being the biggest problem solver. So, one of the most interesting companies and CEOs I've met over the years is a guy called Mo Ibrahim, who started a mobile phone company called Celtel in Africa. And he's a Sudanese-born engineer. He started British Telecom's mobile phone company in the 80s. He became an expert in mobile phone telecommunications. He made a fortune in Europe in the 90s. And then he decided he wanted to go back to Africa. And he set up Celtel as a mobile phone company that would provide services in countries in Africa where no other phone company would go. So that was his mission. So he set up the first mobile phone companies in Sudan and Chad and Central African Republic because no one else would do it. And he ended up making, $1 billion plus out of doing it. So, I mean, my point there is simply, that was, mobile phones can be used for good or bad reasons, but, that was probably a useful thing to do as starting companies goes. And he wasn't overtly doing that as part of a social mission. It was a corporate venture. So of course companies can do amazing things, and with or without the stated mission. The fact that companies now want to have the stated mission, I think, is great, but then they need to be clear about their mission. So and maybe transparently change it if it doesn't work. So the Abraj Healthcare Fund was buying and building for-profit hospitals and clinics in India and Pakistan and Kenya and Nigeria, as I say. Some of the companies they were building out were good companies and still are, like Islamabad Diagnostics or Care Hospitals in India. But they are not going to provide the solutions to the poorest. Abraj would say, well, yeah, we were going to set up some government funding or charitable funding so that then poor people could use the services for free. But that hadn't actually happened.
Well, I mean, and I would argue, even if it would have happened, the argument was that you were building something that was profitable and providing services to the poor. I mean, inserting a charitable effort is a different effort, right? It's a different business model. I
agree. Yes, absolutely. So it's very important to be clear about your stated goal. And if you start off with a goal and you realize it's not achievable, then be transparent, then change it, but change it transparently, because otherwise it looks like deception.
Yeah.
And I it may sound like a detail, but it's if companies are going to sort of set out to help the UN end poverty, then transparency is a vital ingredient, because otherwise they're not going to have public trust. And this is an issue, right? And private equity is historically a private industry. And the private equity industry is very precious, in my experience, about discussing things publicly. They get quite indignant. So in the UK at the moment, there is a lot of criticism in the media about the private equity firms taking supermarkets and other companies private. Now, you may or may not agree that's a good thing or a legitimate thing, but there is a debate going on about it. And I do speak to people in the private equity industry in the UK who get quite indignant about the coverage of their industry. I mean, they should jump in and express their opinion, not get indignant about it.
Right.
I mean, we're talking about large companies that have millions of customers, thousands of employees. I mean, so this question of transparency and inclusion in the conversation is really important if private equity wants to take on more of a social mandate.
Yeah. So yeah, and then I mean we have comments. I have quite a few questions now, and also to address, but comments in the chat. So if you have basically a $1 billion healthcare fund that is meant to serve poor farmers that cannot afford it, that somehow the math doesn't work out. So again, it goes back. Did no one actually ask that question? Who's gonna basically pay for those services? I mean, you just mentioned governments. Of course, I mean, if we would be in Canada or in Germany, of course, you get government-provided healthcare services. So it doesn't matter what your income is, you will be treated, right? And so there is access to it. But that's not the case in most of the countries around the globe. So, and again, no one asking about the logic or the feasibility of that premise or questioning it and just being too trusting, which puts a question again on the LP side, right? Are we too trusting? Because it was just such a good story and it made everyone feel that they were doing something good while still fulfilling their fiduciary duty towards their investors, their stakeholders, their pensioners, or whatever it may be. So Muf has a good question. He's asking, do you think the financial regulatory system, how about the regulators? I had quite a few questions on regulators. Or maybe the lack thereof. I mean, whether it was in Dubai, in the Middle East, or anywhere. I mean, Abraj said they were regulated in multiple jurisdictions, not just in Dubai, not just in the Dubai International Financial Center. Do you think that contributed to Abraj being able to hide or kind of get away with it for so long?
Okay, those are great questions. So just on the first question about the healthcare fund, there was a lot of debate between Abraj and the Gates Foundation, which was the first investor in this fund, about risk return, like how much money should the fund make, or what profits should it be targeting, versus how accessible its services should be, i.e., how poor could the customers be? And there was a tension there. And fair enough, as long as you're honest about your conclusion, right? And you cannot employ doctors and executives on salaries of hundreds of thousands of dollars a year, as this Abraj was, and recruit people from McKinsey and elsewhere to run this fund. And you can't pay those salaries unless you're making a lot of profit. So the Gates Foundation was, as an investor, was having that conversation. And I guess some of the investors, including the World Bank, were thinking better to have some services, even if you have to pay for them, than no services in Kenya or Pakistan, wherever it was. And again, okay, fair enough, but you still have to be honest about, realistically, who can afford to use those services. It is the middle classes of those countries. It's not the poorest. But there needed to be more of a conversation. And two of the investors in the Abraj Healthcare Fund were Medtronic and Philips, which are medical equipment companies. And they wanted to invest in the fund because it would then build more hospitals, which could then buy their equipment. So, their interest as investors was to sell more stuff. It wasn't necessarily to reach the poorest of the poor. So, investors, a fund is a group of people, institutions that have come together for a common purpose. If the investors in that fund don't actually share the same interests, then you're going to have a problem. And this is an issue, I think, in impact investing, because if you've got a fund which says it can make money and solve the world's problems, and therefore it gets the British government and Goldman Sachs as investors. Do Goldman Sachs and the British government have the same objectives in that fund? I mean, the Goldman, the investment banks clients might want 20% IRR, annual returns minimum, and the UK government might be okay with 5% annual returns. And the private equity firm might say yes to both, hoping they'll get 20% plus a year and everyone will be happy. But if that's not realistic, then they are going to have a problem. And that tension did exist within Abrage's investment funds, where you've got development finance institutions as investors alongside investment banks.
Right. I would argue that usually that is being solved by the private equity agreement that you have, right? The limited partner agreement, which usually succumbs to most favored nation status, which means in principle it is the same agreement with all of them. Meaning, if a promise or if an expectation is raised around a certain return, that applies to all of them. I mean, you cannot raise a fund where you promise one set of investors X% and the other one's 10 times X, right?
You absolutely, but you might make that promise and not reach that objective. So, a fund which has investors, just development finance institutions, which are all okay with a 5% return, that's a more realistic scenario, perhaps, than a fund which has a Goldman and a Bank of America and 5 DFIs. So, but when the firm is trying to raise the money, they might just be making promises to get the money and then hope everything turns out all right.
Sure.
So on the regulatory point, yes, regulators need to do a lot more. So, and not just in terms of observing or monitoring for fraud, but now in this new world of ESG and impact, they need to be more alert to issues of greenwashing and impact washing. So when we first were told about problems at Abrage in early 2018, we asked Abrage to comment, and one of the senior Abrage executives, who was American, he was a former US government representative to the World Bank who joined Abrage, his response was, how dare you ask this question? Of course $200 million is not missing. We are regulated in 7 jurisdictions around the world, and we have the highest standards, and your question is basically offensive. So when Abrage subsequently collapsed, a few months later, in June 2018, it filed for provisional liquidation in the Cayman Islands because its holding companies were actually incorporated in the Cayman Islands. Initially, no regulators really appeared to be doing anything in any of those jurisdictions. With them, it's a long story, but we basically, by October 2018, we had the information from other sources to show hundreds of millions of dollars had been taken out of Abrage's funds, and from there, at least $200 million had been sent to the bank accounts of Arif Naqvi and his companies in the Cayman Islands, so siphoning money out. And we published this article on the front page of the Wall Street Journal October 2018. I mean, it didn't look like any regulator in the world was doing anything. Until 6 months after that, in April 2019, Arif was arrested at Heathrow Airport in London, coming back from Pakistan, because the United States Department of Justice had criminally indicted him and 5 of his colleagues. I mean, it wasn't the Dubai regulators that moved first, or London, or Singapore, or Mauritius. It was the Southern District of New York, which is, the jurisdiction that kind of takes white collar crime most seriously in the world. So a lot of regulators, from what I saw, did nothing. Then now we have this whole world of ESG and impact, and we've got investors making promises and pledges, which is regulators now need to get on top of. And there's an issue now with DWS, which is the asset management arm of Deutsche Bank, which you may have seen covered in the press, where a senior executive, Desiree Fixler, got fired, then blew the whistle about DWS making ESG commitments publicly, but not honoring those commitments. And now the SEC is investigating. Equally, at BlackRock in the US, there's a whistleblower there, Tarek Fancy, who's saying that BlackRock is not serious about its ESG commitments. There's no news that regulators are looking into that, but that is an area that regulators are going to be scrutinizing a lot more from now on.
I mean, to give at least the SEC credit, the new chairman has basically indicated that aside from what he's kind of written on his flag as crypto on the one hand that he would like to keep a close eye on, and the second one is anything related to ESG and impact investing. Again, regulators are usually not known to be fast to something, so who knows what's going to happen by the time they come out, but at least it is on their radar. New questions came in. Do you think that the fact that many VC or PE funds are incorporated in tax havens is a structural issue that should be addressed by the world or perhaps the regulators to enhance transparency as well as avoid scandals as the one with Abraaj?
Yes, in a word. So
bring everything onshore?
Well, so when Abraaj collapsed, I asked the Dubai Financial Services Authority to talk about what was happening. They didn't want to talk about it much. Then I asked the Cayman Islands Monetary Authority if they could talk about it, because Abraaj's main holding companies and most of its funds were incorporated in Cayman. And the Cayman Islands Monetary Authority said it's not their job. It's just not their responsibility. Now, what has subsequently come out, because the Dubai Financial Services Authority sort of posthumously did an investigation of Abraaj and fined the firm $315 million for misleading investors, but after it had collapsed, so that fine will never be paid. But what they said, and they did publish two pretty detailed reports, was that the company that the Dubai regulators regulated, which is called Abraaj Capital, which is incorporated in Dubai, was not the fund management company of Abraaj. The fund management of company of Abraaj was called Abraaj Investment Management Limited, which was incorporated in the Cayman Islands. And the Dubai regulator says it wasn't our job to regulate that company. Oh, and by the way, that company shouldn't have been operating in Dubai, but it was. And so the Cayman Islands has already told me we don't regulate it. Dubai regulator is saying, actually, we don't regulate it either. So checkmate. Regulatory arbitrage. Abraaj effectively did not have a regulator for its main fund management business. So they'd found a loophole in the regulatory system, which made it even harder for regulators to understand what was going on at Abraaj, and that's not a good situation to be in.
So if one does the trend of GPs or private equity firms themselves getting listed, will this help? So, I mean, we have Blackstone, we have KKR, we have Carlyle, we have quite a few of the very large private equity funds that are now listed entities. Is that going to open the doors a little bit, make it a bit more transparent?
It should do, but yes. I mean, it's there is more transparency when private equity firms go public, but there are also still quite big unanswered questions. I mean, there are different share classes often, so we don't really understand who's in control and to what extent exactly. They don't publish a lot of information about their portfolio companies. They would say they don't have to. Bridgepoint in the UK has just gone public. But there's a story. It's in the news here that the partners haven't gone public about their carry, how much money they make. I mean, but the issue is with these private equity firms that are going public, they are creating balance sheets for themselves by going public. So in the very old days of private equity, the argument was that the objective was to have maximum alignment of interest between the private equity partners and their investors, GPs and LPs. And the way that you did that was by having the primary way that the GPs make money was through carry, through their share of profits. And the argument was that incentivized them to make their investments as successful as they could. And then they were supposed to take a management fee, which wasn't supposed to be huge, to pay for their expenses. But now in the private equity world, they're raising very large funds with very large fees. And then they've got these balance sheets which they're accumulating, which become a way to earn money regardless of the performance of the funds. So there's less of an alignment between the interests of the LPs and the GPs. And that was very obviously part of what went wrong at Abraj. It could at some point not be an issue at these other private equity firms.
So we're getting to the end of the time that you kindly promised us, but I mean, maybe just taking what you just mentioned, I mean, is there an opportunity for a jurisdiction, a country to improve on the structures of those investment vehicles, potentially come up with new investment vehicles to ensure that they stay true to their original mission of impact? So are there better ways to structure impact investing?
Yes, definitely. Particularly in emerging markets or developing countries. Private equity is important because it's putting money into the companies and parts of the economy that are not publicly traded already. And in developing economies, most companies are not publicly traded. So it's important to get investment capital into private companies or startups. It's a really important part of the economy. But a 10-year fund doesn't necessarily work well in a country with a young and fast-growing economy. It can work well, but if you're building hospitals, for example, it's going to take longer than 10 years to do that well. And yes, I think there needs to be more transparency, and that could create trust. So there needs to be more participation in the way this capital is raised and allocated from citizens who are outside the financial system. I mean, this is something that concerns me a lot, that the discussion about finance and private equity, it is always effectively between quite a narrow group of people. And if we're really talking about providing public goods for humanity, then it would be good for humanity more broadly to be a bit more involved in the process, and that would be quite educational. And and if we're raising money for the LPs, and the LPs are all American pension funds, that's not going to help the inequality problem in the world, is it? So it would be good to get more investors, pension funds from the local markets to invest, and then they have more of a interest in what's going on. If you have a Kenyan pension fund investing in a Kenyan private equity fund that's investing in Kenyan companies, that's ultimately, I think, a healthier situation. There's more scrutiny, there's more interest in what's going on.
they may also have a better understanding of the portfolio companies it's being deployed into. So basically, and that may be an interesting note to finish off. Number one, there's work to be done to create potentially models and fund models that will make impact investing better, more transparent, and hopefully channel much needed funds to the right kind of enterprises. And the second message that I heard from you is it's really important to bring the right kind of people around the table. So not just have the conversation on where money should go being done from the hills of Davos or from far away, by people that have never had an opportunity to experience what the issues are actually on the ground. It's not going to be easy. I mean, there have been efforts to bring the right kind of people around the table, but it's complicated. And when it comes to those sovereign wealth funds or investment vehicles from emerging markets, it is early days. I mean, we've seen emerging markets come out and set up their new sovereign wealth funds in the last 10 years, which is interesting. But like I said, it's early days. So, okay, very good. I know I have had a couple of my colleagues in the room that are actually doing research on that matter. So if I may pass your email on to them. So maybe there's some opportunity we can bring a smaller group together for a conversation. So let me say thank you very much. Thank you very much to Simon Clark from the Wall Street Journal.